There's one person I always look forward to interact and react, and that is Stephen Roach, to understand his view on the economy, politics, and also which way the global GDP is about to move. Mr. Roach, such a pleasure to have you back on EP Now. Thank you for joining us. Mr. Roach, we are talking to you at a time when everybody is, in a sense, trying to understand that who's going to occupy the next White House, what will be the impact if the Democrats get the White House back, and everybody is trying to also analyze, or in this case over-analyze, that if Democrats do not come back with a overwhelming majority, what kind of uncertainty it will have in the world. So what is your sense? Which way things are likely to move?
Well, I think what's at stake from a sort of a policy perspective is the role of the government in guiding and shaping our society. But I think, we all get caught up in the moment, and it's difficult to really put an event like this in deep historical context. But certainly in my experience, and I've voted in many elections over my now long life, I cannot recall a presidential election where there is this much focus, this much tension, this much anxiety as that which we are experiencing right now. So this is really a defining moment for America politically. It's a defining moment for our future and really the character of our nation.
So, Mr. Roach, what to your mind is exactly at stake?
Well, I think what's at stake from a sort of a policy perspective is the role of the government in guiding and shaping our society. But I think what's also at stake is the core value proposition of the great American experiment. We have a very polarized nation right now with views that widely diverge on both sides of the spectrum. And unfortunately, there is little common ground for a compromise, which is something that our system has been extraordinarily effective in achieving over 200 and some odd years of our history. And the unwillingness, the lack of compromise on all issues, of course, dealing with the pandemic is at the top of the list right now in terms of the concerns of the U.S. population. But the philosophy of our judicial system, the role of government versus markets in guiding our economy, our social issues, our racial issues. Those are all at stake in this election right now. And so the choices are stark, and unfortunately the middle ground is not easily discernible for voters who do not really want to go to an extreme direction on any of those areas.
Mr. Roach, now markets of Wall Street is working with the assumption that there will be a blue wave this time. What if those assumptions are challenged? What if the underlying margin of victory for the Democrats is not strong? What if they are not able to control the Senate? Could that have a strong and a very sharp impact on benchmark indices, at least in the near term?
Well, I think the polls are certainly right now leaning in favor of a victory for Vice President Biden. But we saw what happened with the polls 4 years ago. And so there's still an enormous amount of uncertainty associated with the outcome. There's also the uncertainty associated with the potential disputing of the results by President Trump were he to lose. And then there's also a question of the margin of victory and whether or not this has any impact on the political control of the Congress, especially the U.S. Senate, where there are polls that suggest that there's a very good chance the Democrats could recapture the U.S. Senate. If there were to be a large margin of victory for Vice President Biden with control of the Senate, a so-called blue wave, as it's referred to by political pundits, that would certainly alter the direction of fiscal policy in a way that would potentially have meaningful impact on the U.S. stock market. And it would certainly have an impact on the trajectory of our economy in the aftermath, hopefully the aftermath of this pandemic. But, I don't have the view that I think the president has expressed on the campaign circuit that a victory for Vice President Biden would be catastrophic and push the U.S. economy into a depression, and the stock market would price that type of an outcome. I think a shift in political leadership in the U.S. would definitely result in a reordering of our national priorities, and I think a lot of that would be very constructive.
The popular view is that the Democrats, it means more taxes, a tighter regime, more regulation for financial firms on Wall Street, and potentially a breakdown of the big US tech companies. Is that a valid concern?
I think that's too simplistic. I think that while there was a very contentious primary battle for the Democrat nomination, and some of the candidates that you mentioned, Bernie Sanders, Elizabeth Warren, are much further to the left end of the spectrum than Vice President Biden is. That doesn't mean that sort of the central tendency of his philosophy of governance will have to tilt in their direction. He has said repeatedly he's his own man, and I think that you will find, if he were to win the election, a relatively centrist view as to whether or not this means more taxes. He's made it very clear that U.S. corporations can expect that after having gotten a sizable tax break in the Trump administration, and that the wealthiest Americans will also expect tax increases. But for those, I think the number is earning less than $400,000, which is still a sizable sum in the United States. There's a promise of no tax increases. There's also a commitment to do things on clean energy and environment that we have moved away from in the last 4 years. And that is, again, an opportunity to address a problem that is raging out of control in the United States and around the world right now. So, it's more of a reordering of priorities rather than removing or reducing the size of the pie.
Right. Fair point. I'm just going to mark the markets right now for a moment, just to establish that, where exactly and how markets are moved right now. Well, we are in for a very flattish kind of a start. And clearly the fact that there is a second wave of coronavirus, which has spurted up in Europe, and European nations are looking for a second lockdown, more like a partial lockdown, but a second wave of lockdown is something which needs to be considered. So, Mr. Roach, in your book, how worried should one be about the economic impact of the second wave of lockdown in Europe?
Well, I think that's a good question. The epidemiologists have been right from the start. They predicted a second wave to begin in the autumn in the northern hemisphere, and possibly coinciding with the outbreak of seasonal flu, which has yet to actually occur. And after very strict lockdown measures in the spring, I think the general population has gotten tired of the virus, and it's turned into a political issue in some countries like the United States. The second wave is upon us right now, and with Europe taking strong measures to limit what potentially could be a far worse outbreak this time than we saw last spring, the economic consequences of those actions are very important to consider. I mean, we just got a number on the third quarter U.S. GDP, which was a big snapback from the catastrophic loss of the second quarter. But the economy is still sort of 3 to 3.5% below its peak of where it was in late 2019. And that gap, if there's another lockdown, is going to get larger again. And so, we're not in a recovery mode in any way whatsoever. And the possibility of another outbreak raises growth risks, I think, in a very meaningful way looking ahead.
So, Mr. Roach, given that the economy in Europe is still fragile, economic reality has not improved at all, should we expect that ECB will continue a loose monetary policy, and it could be back to what Mario Draghi once famously said, they will do whatever it takes to fix the economy?
Well, I think what we learned in this pandemic, and I think the case of China is most instructive here, that fiscal and monetary policy should not be viewed, to borrow the sort of public health metaphor, should not be viewed as first responders. The first response needs to be directed at the virus itself. And fiscal and monetary policy can just, address the repercussions of the virus, but not the virus itself. And Fed Chair Jerome Powell has pretty much said the same thing, that the course of events will be dictated by our success in containing the virus. And having said that repeatedly in public testimony, he has to obviously be concerned about this new resurgence of COVID-19 that's now evident in the United States. But, as we saw from the Chinese GDP report in their third quarter of the year, where you had good momentum following a vigorous snapback in the second quarter, for those countries that are really fixated on containing the virus, they don't have to use monetary and fiscal stimulus to the degree that countries like the United States, who have not contained the virus, are forced to do. And China's on a much more self-sustaining recovery than is evident in the United States and in Europe, where the virus containment and mitigation measures have been deficient.
Mr. Roach, earlier this week, the US GDP data also came out. Now, optically, we can analyze the data and say, okay, great comeback. But do you think that is arithmetic at play? And frankly, what should one expect from the US economy for 2021? A lot of things would have normalized, a lot of things may have not normalized. And there's a large part of the economy in US which is going to be very fragmented or very, very anemic.
Well, I think that this is going to be a difficult recovery at best. I've looked at business cycle expansions over a long period of time, and stick with the United States for example. We've had 11 business cycle recessions since the end of World War II, and in 8 of those instances, we had a relapse, or what's known as a double dip, where the economy seems to be recovering, but then lapses back into another phase of recession. And in 3 of those 8 instances, we've actually had triple dips, where it's happened a couple of times. And there are 2 factors at work that cause that. One, the lingering vulnerability in the aftermath of a recession. And we certainly have that in the United States, where we remain, as I said earlier, 3 to 3.5% below the peak of late 2019. And secondly, the likelihood of another shock. When you're vulnerable and subjected to another shock, and COVID has a way of seeming to be doing that right now, the possibility of a relapse is very real. So I think this is going to be an uneven recovery. I think we will have a double dip. I think the bounce back that was just reported in the United States for the third quarter of this year was arithmetic. There was no self-sustaining dynamic to it. We took an economy that had been closed and we partially opened it. And if you move from being closed to partially open, the dynamic, the delta, the mathematical comparison is large, but that doesn't tell you anything about the future. And with another wave of infection coming, and consumers, they have human nature everywhere, whether they're in China or the United States or in France or Germany. They're fearful of engaging in face-to-face activities where they can be exposed to the disease. The vulnerability and possibility of a relapse is very real.
So, Mr. Roach, when do you think markets and the real economy will align? Markets right now are here, economy is here. Do you think markets will come down or economy will move higher?
Well, yeah, I mean, we've all been waiting for that. There's been a sharp decline in the U.S. stock market in the last few days, but you don't want to take anything too seriously from a few days of decline. The markets have drawn great comfort from the fiscal and monetary stimulus, looking through the risk of any relapse of COVID-19, focusing more on, the seemingly breathless announcements of therapeutics and vaccines, which are promised, of course, to be around the corner, but the corner keeps getting pushed further and further out. We have an elaborate testing protocols in the United States, and the data on the final phase 3 trials has yet to be gathered, interpreted, and approved by our regulatory authorities. There are some countries like Russia and China to some extent that are rushing vaccines into the system prior to the protocols of approval that we use in the West. And, if the disease has implications for weaker than expected economic growth that the markets are not discounting, the markets will have to realign with a more realistic trajectory for economic activity and earnings. And in the United States, they've been reluctant to do that. The fixation is on the Fed and the hope of curing this disease. And, I fear that's a lot of that's wishful thinking.
And just to wrap it up from our side, Mr. Roach, we know your views on the dollar index. You expect the dollar index to near towards 90, not towards 100. What implications do you think this would have on flow, especially into emerging markets? Because a weak dollar means strength in EMs and a lot of strength in commodities.
Well, it's always a risky sort of speculative area to venture. But for me, one of the biggest changes that I see coming in the world, which will impact the flow of capital around the world, is a large decline in the value of the U.S. dollar. The dollar is, the world's dominant reserve currency, and we have benefited for decades from what former French finance minister Valéry Giscard d'Estaing called the dollar's exorbitant privilege. We live beyond our means, but we take advantage of that as the world's reserve currency, and the world provides open-ended funding for the United States. And I think that those days are coming to an end. We are in the process of piling up a massive record current account deficit underpinned by a equally profound shortfall of domestic saving that will require us to provide concessions to foreign investors to purchase the dollar-denominated assets that we need in order to grow. And with the Fed limiting interest rates from providing more attractive funding terms, the currency will bear the bulk of the adjustment. I look for the broad dollar index to be down by 35% over the next year and a half. It's not out of line with other large depreciations that have happened in the dollar in the past, but this will be a big shock, and some, but not all, emerging market currencies could benefit as a result. I look surprisingly for the euro to be a major beneficiary as well, as the European authorities have finally agreed to validate a pan-regional fiscal policy. So the decline of the dollar raises important questions for the flow of capital around the world, and emerging market economies who manage their finances and their growth strategies effectively could well benefit from that decline.
All right, Mr. Roach, appreciate your time. Thank you for joining us, and certainly hope to see much more of you going forward.